Thanks for tuning in and welcome and g'day, ladies and gentlemen. Today's webinar, we are going to be focusing on a bit of a review of the 2025 calendar year to date, and we'll be providing some insights on what the 2026 outlook looks like. My co-panelist today is Martin Jack, one of our specialist financial planners here in the Gold Coast office, focusing on the APAC region. Good morning, Martin. How are you?
Doing well, James, and good to have all the listeners in the background. So thanks for joining the webinar. Looking forward to walking through this with you and reading the tea leaves into 2026.
Exactly right, mate. And for those that are tuning in, a bit of housekeeping before we kick into the slides. If you do have any questions that you would like us to address at the end, because we are going to have a bit of Q&A at the end, then please drop them into the question box. We did have a webinar last night, which is for the EMEA region. Some great questions coming out about tax, super, transferring money home, property. We'll cover it all today if we can. But please drop those questions in if you think of anything, and then off we go. Recordings will also be made available after the session. It does take an hour or two for it to automatically put up into the cloud, but then we'll be automatically sending out those emails for those that have attended today or who have registered. So let's kick into it. What would a webinar be without a disclaimer? So all this slide is saying is that the presentation provides general information only. It doesn't take into account your personal circumstances. It's not financial advice or a recommendation by any means, but please consider whether the information that you're taking on today is obviously in your best interest before making any decisions. Ensure you seek advice from a qualified tax professional or a licensed financial advisor. Who is the Atlas Wealth Group? Well, we are the leading provider in Australian expat financial, tax, mortgage and asset management services. We are regulated up to the wazoo by ASIC, the ATO, the DFSA. I have no doubt in the coming years there'll be a couple more initials there. We have clients in over 50 countries. We manage over 500 million, and that is actually climbing very quickly towards $1 billion, I would say, over the next 5 years. All of our specialists are degree qualified with numerous postgraduate certifications. The agenda for today, we are going to be touching on a bit of a macro backdrop, Australian equities, internationals, interest rates, the impact it's having on the Australian property market, touching on the Australian dollar and currency movements, and then things to think about when it comes to managing your own portfolio, so portfolio implications, and then a bit of Q&A at the end. Now, jump into a bit of a macro backdrop, and this is covering off the last 2025 year as it was, because we are fast approaching pretty much that holiday period where everyone shuts down and goes kumbaya. So let's have a look at it. Global economy, slower growth, but policy shift and persistent uncertainty. So when we look at global growth around the world and that GDP, 2.4 to 2.8%, depending on the economy that we're drilling down on. Advanced economies have been sluggish, whilst emerging markets have actually been surprisingly resilient, given, I would say, given the relative strength of the US dollar throughout the year as well. Inflation, we've seen a disinflation trend throughout the year, continues globally. CPI is easing towards that 3 to 3.5%, which is a good thing. Global rate cuts slowing and pause. So we'll touch on interest rates later, but you'll see there in a really important graph that central banks, they are starting to diverge a little bit. The US Fed is very cautious at the moment. They kind of need to be due to the unknown of the tariffs. ECB in Asia easing faster. So markets shifting from rate expectations to earnings. We've also had a lot, I would say, going on when it comes to that geopolitical and trade tensions, tariff uncertainty, supply chain realignment, shaping investment decisions, sort of this globalization risk remains. Structural themes, AI adoption. Just before we kicked into it, Martin and I were discussing the video earnings because we've never seen a share market so poised and holding its breath for a single company's result, and the result was very positive. We were drilling down on that about what the revenue said as well as what the accounts receivable said, because you really want to drill down on the cash profit, not just what they've got recorded on their financials. Energy transition happening in the background, and then demographic shifts influencing long-term growth and capital flows. If we bring it home and we look at how Australia's gone, GDP growth has been relatively slow, 1.8 to 2% in 2025. Private consumption has been rebounding, but productivity remains relatively weak. Our inflation, headline inflation, 3%, trim mean 2.7 to 3. Some good inflation early in the year around your sort of May, July and August, but more recently that inflation has popped up again. Right now, keeping the RBA very cautious. RBA cash rate sitting at 3.6%. Further cuts are unlikely, I would say. Probably at least for 6 months, that inflation print was just a little bit too high for the RBA to do anything. Housing, property prices, they're up on average 5 to 6% year to date, which is actually all that residential property needs to be doing. Affordability challenges remain despite rate cuts. Some risk there in the background, very similar, I would say, on the global side. So global trade uncertainties, weak business investment, and then some structural productivity drag as well. Upside from net zero transition and tech adoption. Net zero has definitely been popular recently with the coalition, so potentially abandoning that. We'll see. Susan Lee's got a tough job at the moment to hold her seat and remain leader. Coalition might be no more. We'll change tack and I'll now hand it over to Mun to touch on Australian equities. Ooh, Mun, can you hear us?
Oh, there we go.
Lost
you
You're
there
back.
for a bit of time. I'm back now. Good. Okay, so I'm assuming we're up to the Australian equity section, but obviously, when we look at the chart, it's been anything but smooth. Year-to-date performance sitting around that 3.26%. If we had this conversation at the peak, probably about a month ago, around that October period, you'd probably be grinning left to right, I would say. But I think this graph itself paints a pretty good narrative. And the ride, whilst we've had a recent pullback because of numerous factors that could sort of feed into that, we've seen some really significant drops. You can go right back to sort of earlier in sort of April, May period where we had Liberation Day tariffs and the significant drop you can see in the chart there, followed by that very V-shaped looking recovery. And then naturally beyond that, it's increased too. So currently we're sitting at around that 3.26%, but obviously context really does matter. So the mid-year recovery was obviously really, really impressive. The markets seem to have overreacted, or at least the TACO acronym started floating around, which is Trump always chickens out, and as a result, sort of markets rebounded quite quickly and have really priced in a lot of the tariff threats moving forward. But it does suggest that there is sort of momentum across the Australian equities has cooled a little bit. It's not always a straight upwards trend. It's more of a hard grind higher with plenty of bumps along the way. And with Nvidia's recent announcement as well, we'll probably see a nice lift today, or we likely will. Now, if you look back, obviously year to date, not over yet, so we still might go into a Santa rally or a Christmas rally, and then into the January effect early next year. So we are looking at it in a snapshot in time, and it is a short period of time. So if we zoomed out a little bit further, we went back 2 years, and we look at, well, how has the ASX performed over the last 2 years? And it's up nearly around 20%, even considering the most recent drop as well. So always focusing on long term and focusing on sort of the basis of remaining invested in the market, and not in the short term, pulling some rough or some I suppose high level cause of pulling out of the market. But obviously, this is showing that it's not a runway bull market. It has been a steady climb considering the headwinds. The volatility, it reminds us that gains are not linear, and staying invested through these dips has always paid off, and that sort of is exemplified over the last 2 years, and then moving back further than that as well. But in terms of sort of some of the sectors, I might just get you to change the slide there, please, James. So the sector leaders were obviously the financials, communication services, healthcare have outperformed on really strong earnings and defensive positioning. The lagging sectors were the real estate investment trusts. We also had consumer discretionary, which was softer due to higher funding costs and cautious spending. There was a lot of earnings resilience, with corporate earnings broadly holding up despite the slower GDP growth and profit margins. And, I think that's pretty important because when we consider, the Australian stock market, dividends tell a really good part of the picture or part of the story there. Australia's dividend yield always remains quite a key attraction, especially when global yields can tend to trend lower, when we have such as the Fed starting to cut rates potentially as well. Volatility is obviously still here, and it has been here over the last year. So commodity swings and trade uncertainty can quickly change that sentiment as well. But all in all, 3.2%, 26%, it's not, shooting the lights out or anything like that, but it is today's return after a really terrible November, three back-to-back losses in a row, three back-to-back weekly losses, I should say. But yeah, we'll probably see a bit of a rebound tomorrow, not today, I would say. Jump across to the next one there, please, James. Some of the key drivers here, we have valuations, the ASX 200 trading at near long-term averages, earnings multipliers are supported by our resilient corporate profits. The earnings trend is the consensus expects mid-single digits earnings per share growth. Financials and healthcare remain key contributors. The macro influence is looking at slower GDP growth and sticky inflation, which could cap upside rate stability supportive for real estate investment trust recovery as well. Some of the sector themes, we're looking at financials, resources, tech and healthcare. So on the financial side, we're benefiting from stable credit conditions and margin normalization. And the resources, commodity price volatilities are tied quite heavily to China's demand and energy transition. Tech and healthcare, structural growth and drivers are intact. One of the biggest risks, obviously, for Australian equities is global trade uncertainty, domestic productivity lag, and geopolitical tensions. One of the core messages when we look at Australian equities is that dividends do remain a pretty big part of total returns of the ASX, and it is a key differentiator compared to many of the global markets as well. So we always do need to consider that. But it still looks like there will be a positive outlook, moving forward for 2026, and obviously these will be the key drivers above that. But looking outside of Australia and on the global front at the international equities, they've performed relatively strong. Well, not relatively strong. They have performed very, very strong, I should say. We all know that the AI-driven tech rally has impacted the S&P 500. We just had a chat yesterday at our investment committee where we were talking about how information technology is making up about 36% in that sector alone of the entire S&P 500. So obviously there's a risk associated with that. But because of that rally in the tech space, that's naturally bolstered the returns across the S&P 500 and then also the world index that's sort of associated. So, if we look at the S&P 500 year to date, 12.75%, shooting the lights out with that one. The world index, 14.86% for that one as well. Some of the drivers for that, I'll just get you to change the screen there. When we look ahead into 2026, the S&P 500, the forecast from a lot of analysts at the moment is seeing a lot of growth. There's a big risk that this could see the opposite side in terms of if tech doesn't and AI doesn't actually eventuate in the way that it's sort of being portrayed at the moment. We'll talk about that in a moment regarding potential AI bubble, but the forecast as it stands at the moment for the S&P 500 is 10 to 15% upside, which is quite significant. Now, naturally, this is obviously driven by the AI capex cycle, strong earnings per share growth of around 12%, and then easing rates as well. The risk is naturally the very tech-heavy concentration and typical frothy indications such as overvaluation or valuations being extremely stretched. On the global scale, we can expect the world MSCI to gain around 5%, mainly supported by Europe and Japan rotation. Valuations are a little bit more attractive outside of the US at the moment. Fiscal stimulus in Europe and the yen weakness in Japan can naturally support that as well. Moving into some more equity themes. So if you could just change to the next. Oh, you already have. Yep. The emerging markets looks quite attractive as well if you want to look outside of the US, specifically in India, the ASEAN, Taiwan, South Korea, with the focus on those semiconductors and AI hardware. The risk to emerging markets is the China slowdown, tariff uncertainty, geopolitical fragmentation as well. Some of the sector themes will remain tech and AI, assuming the narrative continues around that and we continue to see good reports like what we saw out of NVIDIA. So naturally, that's going to continue to bolster those markets and the companies that are sort of tethered to that too. Energy transitions from renewables and EV supply chain are likely to remain strong throughout 2026. And on the financial side, we can benefit from the tailwinds of rate cuts and credit stability too. Is it a bubble? This is a conversation I've had with a lot of my clients on some of our annual reviews and regular check-ins. And, there's a lot of signs that are sort of reminiscent at the moment of the dot-com bubble in the late 1990s and early 2000s. And, we have these companies that if you reflect back to, 2000, early 2000s, we had the dot-com, we had these companies that were essentially opening their companies. And as long as the company ended in dot-com, VC firms and investors were throwing everything at these companies on the bet essentially, or the punt that it's going to be the next big thing and change the world as we know it. And granted, it certainly did, and some companies did, but then some companies didn't. Pets.com as an example, everyone was throwing money in Pets.com, but they were losing money left, right, and center. And then when they listed, they listed at a very high share price. By November in the same year, they went into liquidation. So we went through this period of substantial growth, specifically in the information technology sector, primarily based on speculation and hype in a lot of these companies. And that sort of scenario and narrative is being echoed a little bit today. If you look at some of the divergence between the information technology sector and some of the other GICs that we have exposure to on a global scale, there is a significant gap there. And, it has prompted this question of is there actually an AI bubble? When we look at the companies themselves, we need to remember that these companies are established companies. We're in a very, very different space to what we were back in during the early 2000s. These companies have good cash flows behind them. They're established businesses. But that being said, valuations for a lot of these tech companies, they are very stretched. The mega cap techs are trading at extremely elevated price to earnings ratios, which is one of the biggest signs of a bubble straight away. And whether or not the AI is going to be as transformative as the share price is demanding at the moment. And that will be fed through the earnings reports and the forecasts, such as, what we received from NVIDIA over last night. Naturally, there's lots of signs of froth, heavy ETF inflows and aggressive earnings assumptions. There's persistent factors with strong AI infrastructure demand and corporate adoption. Risk, there's a sharp correction in growth lags, expectations. There's regulatory scrutiny as well. Taking a bit of a balanced view can allow you to diversify beyond just US mega cap stocks in global opportunities. And obviously, as we've stated a few times, NVIDIA earnings was a good litmus test. But, when we look at it, you're sort of in one of two camps typically. You're either in, it's a bubble, it's going to pop. What do I do? Should I jump on the sidelines? Or, it's not a bubble and, it's going to be transformative and going to see this rally in the markets. And there's arguments for and against, but what you should probably avoid is jumping out too soon. And the main reason if you jump out too soon is the risk of it actually continuing is very material, and you don't want to miss out on those best days in the markets and that continued rally. Because if it is transformative, then you're going to have to jump back in at much higher prices. So remaining invested, regardless of if it is a bubble or not. But more so and promptly taking profits from those companies that are experiencing that significant growth, diversifying that across the other sectors that you can invest in, not just in the information technology sector as well. Yep. So is it a bubble? Me personally, I think it is a bubble. I'm not sure, James, if you got other opinions, but whether or not that's going to pop today, sort of is throwing us back to, the dot-com bubble. Are we in 97, 98, 99 or 2000 if it's going to pop? And it's far too soon to tell. There's a lot of capex, there's a lot of injection, and there's still a lot of hype in this of whether or not, that's going to pop today or if it's going to continue. The chances, if it is going to continue, the chances that the Mag 7 and the big tech companies are the only companies to actually benefit from AI is very low. It's going to flow through to every single company. So rather than trying to predict and make that decision and focusing purely on one approach. It's best to ride the frothy market, likely take some of the profits, diversify it out beyond the US mega cap tech, and then just focus on the long term view there.
Yeah, I mean, I think it could keep going for a little while. I think over the next 12 months, we are going to see very disciplined reevaluation of the AI in the tech sector, especially in the US. I think we need to remember that a lot of these, the Mag 7, a lot of them are producing genuine earnings. And you hit the nail on the head, whereas back in 95 and the tech wreck and the dot-com bubble, that was all built off hype. But these businesses which are trading now, they've got years of balance sheets, they've got years of earnings, and they're monetizing it very, very well. It's when you start to see overcapitalization, that return on that investment just isn't there. And, there's just a black hole of expenses. And some of that we've seen a little bit. I think there was an article that came out recently about one of Oracle's AI data centers cost 354 billion. It's now been written down to 71 billion. So there's a huge loss on someone's balance sheet. So we might see more of that, but and therefore there is a bit of a froth there. When you look at the Mag 7, it's making up 36% of the S&P 500. So we look at the other 493 companies in the US. When you look at the earnings results from a lot of those companies, they're all actually relatively strong. So we can see that I don't think we're going to have a recession or anything like that in the US, but certainly within the tech sector, there is a bit of froth. And again, those valuations are definitely stretched. So it's being mindful of that, maybe diversifying a little bit, consider maybe different sort of thematic or active beta strategies that you might deploy rather than just S&P 500, maybe equal weights, those sort of things. But it's definitely one to watch. And I know as soon as the NVIDIA earnings result came out, the accountant in me downloaded and obviously looked at the financials that they produced. I looked at the earnings. I was looking at the accounts receivable because I don't like when companies' earnings are reported to be, a big beat, but everything's on a contract and it's not actual cash profit. I don't like that. And we'll see a lot of that in the tech sector. Everything will be on contract, but it's not actually cash in the bank. We did see their actual cash receivables pick up, their accounts receivable, but we also saw their cash profit pick up as well, which is really good. That's what I was looking for. So I do believe you'll see the tech theme continue. I think we will see a bit of a Christmas rally, and then that'll carry over into some portfolio rebalancing with that January effect as well. So I agree with that. Moving into interest rates now. So that was a good summary there. Interest rates. I love these two graphs because they paint a terrific picture. Trying to get the up-to-date data out of the RBA and the ABS is always difficult, but this is relatively up-to-date looking at where those central banks sit at the moment. The RBA right now, we're sitting at 3.6%. The Fed, they are likely getting very close to the end of their cutting cycle. But when we look at sort of what the market is pricing at the moment, minimal future cuts, especially over, I would say, the next 6 to 12 months until that inflation has come back. However, we have just seen growth continues. Growth is continuing on share markets regardless of what interest rates are doing. We know consumer spending has been stymied, but consumer spending is still there. We know probably companies which are more discretionary spending haven't probably performed as well. Even non-discretionary, Woolworths, as an example, hasn't had the best year, but its revenue has gone up, but the share price tells a different story. Policy rates, it's really interesting looking at these graphs because you can see that an event like COVID-19 causes this big economic reset. And you see most developed or advanced economies following the exact same path. There's obviously a lot of diversion through these years, and then we have the Great Reset, COVID-19. Everyone drops their cash rate to zero. Money's cheap. Money's easy to access. And then obviously we go on all the same path. And now we start to see this divergence again. And the divergence is just due to that economy, I would say fiscal policy response as well, not just monetary, and how each economy is tracking. But we're all on a very similar path at the moment. And then obviously Australia is sitting at that 3.60%. So if you're hoping for a rate cut in the next couple of months, you won't get it in Australia. Inflation is too high. I don't think we'll get a rate cut until maybe mid next year if inflation shows that consistent theme of tracking down to that 2 to 3%, or ideally that 2.5% at the moment. If we move over to the next slide, let's look at what the outlook might be for the Fed. So the Fed is expected to gradually lower rates through 2026, with forecasts ranging at the moment from 2 to 3 basis points over that entire calendar year. So there's still a bit of room there, but I think the Fed's got a very difficult decision because we haven't really seen the full impact of tariffs yet. We know inflation is tracking still a little bit too high in the US, and we know that Trump likes to run it hot. I think I've seen that in a lot of articles recently. So it could mean that inflation might stay where it is, but he's still going to put pressure on the Fed to cut rates. Key drivers, yes, inflation needs to come down. Slower employment growth, muted recession risk. Central banks officials emphasize a slower than market expect approach to cutting. So where everyone's thinking, okay, they'll cut pretty quickly, but they really won't. It's going to be very slow, and we won't see an aggressive cutting cycle at all by the Fed at the moment. If we look around the world, and obviously working off a bit of average here, central bank in Europe and Japan are moving at various paces. The ECB is probably pretty much done, to be honest, but the overall bias in advanced economies is towards moderately lower rates, driven by that disinflation and modest growth. However, bond yields may not fall in parallel to policy rates, and it's just due to the persistently high debt from governments and fiscal pressures in developed markets. So it does mean that they've got money in the bank account earning a healthy interest rate, especially overseas in Europe. As those rates come down, we're losing, I guess, the value of that because we're no longer earning the same kind of interest rate. So you might see more people pile into bonds if they're wanting, I guess, exposure to a defensive asset class, but a better yield. So we might see a little bit of that, but that's money that's not earmarked for the share market or property. 2026 for the RBA, what are we thinking? I love this graph, and you can download this from the ASX, the RBA rate tracker. And essentially, it takes a temperature check on the market and where they think the implied yield curve is going for the RBA cash rate. You'll see there, especially over the next year, it's not moving much. We're sitting at 3.6%. We might get down to 3.4%. It's very rare that you hear the RBA cutting by 0.2. It's usually in 25 basis points increments. So that could actually mean that we might be where that might be it for us in terms of that rate cutting cycle. It would be great to see if we could get down to 3.1 or 3.35, but it's going to be dictated purely by that inflation figure. Recently, that unemployment rate somewhat tracked the wrong way in the last couple of months. So it's a difficult decision for policymakers at the moment when you've got inflation creeping up a little bit, but you've also got unemployment rate going up. So it's a case where if you were to cut interest rates and inflation keeps tracking up, then you're actually going to have to go the other way and start increasing interest rates. And you can't have this scenario play out of stagflation where you can't get a handle on it because then rates need to go up quite significantly to obviously backtrack it. But at the same time, you could have unemployment going up. So it means you need a bit of a fiscal response as well, not just monetary. And fiscal can be leaning on the political side, tax cuts, all those sort of things from the Labor government. Let's now change over to the Australian property market. Australians, we definitely have a love affair with our Australian property. No question at all. We all love it. I love it. When we look at the capital growth year to date, it's been rather sensible. There's been obviously some terrific outliers. I couldn't believe the result on Darwin over the last 11 months. So this is November up to November from Cotality, formerly CoreLogic. They produce a monthly home value index. Some great data in there. Highly recommend it. If you love your property, download it. Darwin's been a massive outlier, but when we focus on what we would consider your main capital cities, we can look at Sydney, we could look at Melbourne, we can look at Perth, we can look at Brisbane, and I would say Perth and Brisbane obviously have been the main steady performers there, 10.8%, 9.4%. Your regionals, 10.1%. So your regionals are typically going to be maybe your regional capital cities. So that can be the Sunshine Coast for Queensland. That can be the Gold Coast, which we have seen some strong growth. Regional WA as well. So some strong key themes there. But as a national average, 6.1%, that's a really good year. That is a really good year in terms of capital growth. Remember, with residential property, it's rare that the national average is sort of tracking, I would say, above probably 7%. That usually doesn't happen. It's usually that 4 to 6% is sort of the national average that it tracks on. Capital cities can sometimes do a little bit better. But all in all, a really steady year of growth. And that's all you need in residential property because there's often, as an investor, you're usually gearing that asset. You usually got a loan on it, and therefore your true return is more than 6%. It might be double, it might be triple, depending on the capital or the deposit that you put down on it. Let's change tack and look at how the rental side is going, the yields, the growth of it. So on the left-hand side, this is just reflecting the change in rental rates. So how quickly has rents increased? So we can see there as a national average, 4.6%. So that's higher than inflation. Usually we see it increase at a rate of similar to inflation, so that's a little bit higher. And it's mainly due to the housing crisis and that housing shortfall that we have in Australia right now. A lot of the capital cities have such low vacancy rates, and we've probably all seen it on social media, people lining up in Sydney or Melbourne or Brisbane, and the lineup for these open houses for just a rental is, lines of 100 or 200 meters long. Given the most recent one I saw was in Bondi, so that's obviously a very highly desirable lifestyle destination and to live there. So no wonder the line was about 150 meters long. It's just for a sensible 2-bed or 1-bath, renting out, I think, $1,000 a week. So it was surprising to see the line there. But it has tracked up more aggressively than inflation. You'll see some isolated outliers here. Darwin, 8.5%. Brisbane, 5.8% increase. So these aren't the yields. These are just the increases. So we look over the right, this is the yields. Now, you've got to remember, residential property does not provide you with large rental yields. It never has in Australia, to be honest. You might get better yields, and you do, usually from commercial property. Residential, it's very rare that you've got a residential property portfolio that you can really comfortably live off, just because the yields are so low. But combined capital, 3.4%, Australia as a whole, 3.6, and regionals 4.3%. Regionals usually return a little bit more than your capitals based on the value of the property, because the value of the property will be higher in your capital cities relative to the regionals. But the yields will be relatively similar. So we can see the front runners there. Darwin, Perth, Brisbane's okay, but Canberra's done okay, maybe due to all the public servants. But all in all, those rental yields aren't a surprise. We probably will see in the next, I would say, 12 months, these annual changes come back a little bit rather than 4.6% or to 6.1%, probably around that 3.5% to 4% as an average. What's supported the 2025 growth in Australia? Easing interest rates certainly has. There was times where it definitely renewed that buyer interest. Perth and Brisbane dominating the main capital cities. For those that are from Darwin, sorry, I don't sort of treat it as a main capital city. While Sydney and Melbourne experienced modest growth due to that affordability pressures and weaker buyer sentiment. October 2025 saw the fastest growth since mid-2023. And I think that was also the same for loan applications as well. There's actually a bit of a backlog right now in loan applications within the banks. And that was all fueled by that government scheme for that first home buyers, 5% deposit guarantee. Now, the data that the Treasury put out about what that's going to do to the property market, I think on average they said 0.5% or something over the next 6 years, which is a bit ridiculous. In October, because we saw that fastest growth since 2023, a lot of that was fueled by the first home buyers, and we've also seen them increase the house price cap for those. So in New South Wales, it's 1.5 million, which is huge. I think Queensland, it's 1 million, and then it's usually in between the rest of those capitals as well. So that will support some of the growth into 2026, but I think you'll find the polish of that will come off probably in the next 6 months. That's not going to drive growth into 2026 by any means. There'll be a little bit, but not much at all. But overall, price growth this year, was solid. Housing turnover remained below historical averages and reflecting cautious buyer behaviour and slower sales volume. 2026, what's going to drive it? So we still expect price growth of 4 to 8%. That's a pretty big range, but that is all you need from residential property. That is really all you need. You don't need to be chasing double-digit returns because the risk in that kind of residential property would probably be quite significant. You'd be buying out a mining town of some sort or in hype, but that's all you need from residential property because it's usually a geared asset. And by gearing, I mean, you usually got a loan on it. You put down a 20% deposit, you're getting a rate of 4 to 8% on it, then it's actually working really well for you. Key drivers will be if there's any other interest rate cuts to lift that borrowing power and those mortgage rates easing modestly. The average interest rates right now on your mortgages is probably ranging from 5.3 to say 5.8 if it's an owner occupier, and then a little bit more on those investor loans. We won't see interest rates return to those lows that we saw through COVID-19. That's a bit of an anomaly. I'd be very nervous if we did get that low again. That means there's a lot else going on in the world. Government support for first home buyers and targeted policy. Yet these also may contribute to higher prices and affordability challenges for first home buyers. It's a two-edged sword, isn't it? They've increased these prices in which first home buyers can get into, but by doing so, it's also going to drive a bit of that, obviously, capital growth, which means it's going to make it a lot harder for first home buyers over the coming years as well. I would say it's probably not the best policy the government has rolled out. Supply constraints, national housing housing shortfall remains. Yep, still got a housing crisis there, and they need to really deregulate so faster approvals. Migration and construction pressures easing, but they are still existing at the moment. What could change our view on property growth and it, coming back a bit more? Inflation remains sticky, possibly the last rate cut delivered. First home buyer stimulus fading within that 6-month period. Construction costs still remain relatively high. They certainly do. And then that sentiment cooling a little bit as well. Absolutely. Foreign exchange. I'll now hand it actually back over to you, Man, for Forex.
Thanks, James. It's interesting fighting the supply chain, the supply issues with property with demand side schemes. I think that seems a little bit backwards, but nonetheless, the AUD, sort of how that's performed throughout the year, sitting around that sort of 65 cents typically for on average throughout the year. As a result, that's about a 4.34% year-to-date return, so a lift up. If you compare that to the pound, there's been a slight increase. You compare that against the euro, it's relatively flat. Now against the USD, it's fluctuated quite a lot during 2025. It hit a low just under 60 cents at about that 59 cents. I don't know if anyone had the ability to jump on that very, very quickly, but it was there during Trump's whoopsie. And the market's overreaction there. But a high of around 0.71, so 71 cents there. With the exchange rate affected primarily by the divergent central bank policies, commodity price swings as well, and overall just global risk sentiment too. At the start of 2025, we did see some initial strength in AUD, which was driven by that commodity price rebound and also a bit more of an optimistic economic data sort of information that came out in Australia, which was sort of easing inflation and then some solid labour market figures as well. However, persistent concerns around the global growth slowing, obviously the US Fed policy tightening earlier in the year as well, and domestic housing corrections weighed on the AUD, which obviously caused some downwards pressure there. But overall, not too bad for the AUD performance. If we look at the DXY, negative 8.22%. So the DXY is the US dollar index, which essentially measures or tracks the strength of the dollar against a basket of major currencies. And the value of the US dollar against all of these other sort of currencies dropped 8.22%. It was about 11% in the first half of the year, one of its biggest declines in more than 50 years, which is quite crazy to say, and also ending a 15-year bull cycle as well. So initially fell around 10%, sitting at that 8.22%. The weakness in the dollar was primarily driven around tariffs, obviously the uncertainty that followed that as well, the global capital reallocation as well, so people moving their money outside of the USD. Partial recovery came through late this year, but the trend remains relatively bearish across the board. If we have a look at the AUD in a bit more context, so historical band sits around that 0.6% up to 0.8, or not percent, sorry, 60 cents to 80 cents. The current lower mid-ranges there, the strength is obviously comes from commodity support, and the weakness is going to be driven by China slowdown, less the exports, less exports obviously equal less demand for AUD assets too. We'll jump to the next one. Thanks. The outlook for the next 6 to 12 months, the forecast is gradually to see a strengthening against the US dollar and other major currencies over 2026. Obviously for the AU dollar, softer US monetary policy. So the Fed's starting to cut rates. Depends if Trump gets his yes men in there and then they start to cut. Investors are obviously going to start looking for higher return elsewhere. So that's obviously going to typically, I suppose, logically, we see a strengthening in foreign currencies or the AUD when the US federal cash rate starts to drop. Favorable commodity prices will feed into that as well, and relative economic resilience too. We can expect some short-term fluctuations due to central policy signals and geopolitical factors, but the overall trend favours modest AUD appreciation. At a base case, we're expecting 64 cents and then upwards to that 69 cents. So keep an eye out for those two sort of floor and the upper limit there, and somewhere within the middle would be a good price to make some transfers if you are. On the upside, if we get some continuous China stimulus and some softer USD, that's going to bolster our AUD strength. And then obviously on the downside, higher inflation, which if we see that, and also geopolitical risk as well, which feed into it. Beautiful. I'll get you to change to that next one, James.
Back over to me.
Cool.
So what does this all mean? Portfolio implications. And we refer to, I guess, portfolio just mean your total strategy, whether it's in shares, your superannuation or retirement account, property, all things. So let's summarize what this all means. Equity positioning. So if we're investing in direct shares and we're in Australia, then you definitely want to be blending that Australian share portfolio with some global exposure as well. We've just seen how global equities, especially the MSCI, which does capture the US, but how well it's performed over the last 12 months. Within our portfolios, we certainly do have that global exposure, and it makes up actually a significant amount, which is great. Within the Australian Australian equity exposure, our techs in Australia make up a very small amount of our market capitalization within the ASX 200. It's tiny, to be honest. It's under 10%, but you've got some really strong companies in there. A really good one, which I love, is Xero. Xero, it's an accounting and bookkeeping software. It's been around for a while, came out of New Zealand, but their subscriptions are increasing, and they've got a strong moat against their other counterparts, such as QuickBooks or Intuit. Healthcare exposures. So you're marrying the two here. You've got a bit of exposure to growth, but then healthcare. That's what I actually would refer to as a defensive sector, because everyone needs healthcare, regardless of what's going on in the world. And then also marrying that with your typical staple holdings, your non-discretionaries, I would say, your things like your Coles, your Woolworths, things which are always going to keep performing regardless of what's going on around the world. So blending that growth sector with a bit of value and some defensive sectors is very sensible. Dividends. Dividends remain supportive. We are very lucky in Australia where a dividend yield, depending on the company, provides that consistent 3 to 5.5% dividend yields. That also includes franking credits where they are paid up to that 30% corporate tax rate in Australia. This is why our shares in Australia aren't thousands of dollars. They're up to a couple of $100. And you compare that to the US. The US is not known for paying out dividends. Often profits are retained, which feeds back into the share price. And that's why you have share prices over there, which get up quite to a significant amount, a couple of $1,000. And then they have to do a share split. Avoid over concentration, based on that risk premium. So if you are going to invest in Australian equities, we are recommending you diversify across sectors, but then also marrying that with the global exposure as well, being mindful of the risk you're taking on for the return you might get compared to investing in, say, global. That's all. This next slide I love because it shows the power of portfolio diversification within a diversified share portfolio. On the right-hand side, we can see here how different markets have performed up to actually the end of September. I couldn't actually find one which was like this that was all the way up to right now. But surprisingly, you've got some emerging markets there that have absolutely brought it home for the year. Vietnam, South Korea, Hong Kong, Spain, Austria, Poland, Israel, Mexico, Brazil. But you look at some of the size of these returns in those emerging markets, that's huge. Australia, obviously, way down up until the end of September. It was obviously a little bit more than where it sits right now, that 3.62%, trading just below that 8%. But the power of diversification, having exposure to global markets is really, really important. I think when we look at some key takeaways, the weakening US dollar is going to act as a good, strong tailwind for emerging markets because a lot of their corporate debt is usually in US dollars. So they get that natural appreciation of their own currency, which is beneficial if they are unhedged. So that's a really good thing, and that helps emerging markets. And we've just seen emerging markets have still performed relatively well in the current year that we're in. Emerging markets are very volatile though. So if you're allocating any money to emerging markets, it's not a large chunk of your portfolio. It's a small percentage. ASX, we've always got heavy exposure to those old world industries, old legacy businesses is what I like to refer to them as. So that's your financials, that's your oil, your gas, that's your mining, that's your healthcare. Somewhat similar to probably the FTSE 100 actually over in the UK. But they account for such a large amount of our ASX 200, over 50% actually. It's closer to 65. And those companies, and we're not going to see them shooting the lights out with double-digit returns. They're going to be giving you, those 4 to 8% capital growth returns, but then you've also got to factor in the terrific dividend yield that they give you as well. We love that. It's a terrific hedge against inflation, those dividend yields. Property positioning. So in Australia, we all have a love affair with property if we've already invested in it, but being mindful of avoiding high leverage. So keeping your loan to value ratios at a relatively sensible level, sort of maximum 80%. Therefore, you're avoiding that loan mortgage interest or that LMI, but it also keeps a healthy buffer on the market value between that loan in the event there is a bit of repositioning. I don't believe if you were to download Cotality's long year performance on the Australian market and you drill down on capital cities as an example, we've never seen a period where a property market has, say, dropped 20% in a single year. You might find some old mining towns and suburbs where that's happened, but it's rare that you want to invest in those. But in terms of capital cities, regional capital cities, we haven't seen any year where they've really dropped significantly. There's been sidestepping, might have been a small sort of pullback of 5 to 7% across the 12 months, but no big drops. And we've got to remember that property is that slower asset class. You build wealth slowly through property, but the benefit of it is it allows you to gear it, get a loan on it, so you're not committing just all your after-tax dollars, and off you go. Focus on what has always worked. So don't try and reinvent the wheel here or reinvent a new investment strategy for property. Capital and regional capital cities, they work. Focus on the growth corridors between a regional capital and a capital city. Quick example, home buyers, Gold Coast, we're a regional capital, but there's a growth corridor between us and Brisbane because they're an hour up the road. All that will fill in over the next 20 years. Absolutely. I remember going over to Stradbroke Island early in the year with some friends and family, and we did a triathlon over there. Sorry, I'm digressing. Part of the story. But there was a whole new town and city in between here and there, which had just filled in the last 5 years. There was new developments, there was a shopping centre, and it all used to just be cow paddocks, essentially. So it blew my mind how quickly it had filled in, to be honest. And then I'm looking at what houses are selling for in that area. It's over 800,000. I'm like, Jesus, what's happened here? Been completely blind by it. When you're looking at other factors for investing in property, look at low vacancy rates, strong infrastructure development within that area, good amenities, hospitals, shopping centres, schools. Try not to focus on the historical growth which we've seen in the last 5 years. COVID-19 has skewed those numbers. If you look at any suburb, regional capital city, you would have seen that it would be tracking along at that sort of 4 to 6% on the long year average, and then COVID-19 came along, and then you're seeing these big explosions. So whenever you're considering an investment in property, don't just look at the last 5 years. Look at the growth over the last 25 years. That's a much better measure as to whether it's sensible. When you're looking at property, you're not looking for double-digit returns. You're looking for sensible returns. 4 to 6% is all you need when it comes to investing in property. Caution on buying off-the-plan property purchases. Still seeing some builders going bust, committing to those fixed price contracts, but then everything goes up in value. It's definitely seen the cost of steel go up and double or even quadruple in some areas. So caution on purchasing off the plan. We've definitely seen units do relatively well in the last 12 months because they're a bit more affordable for those first home buyers, but just be mindful of buying off the plan. Currency exposures, how and you should manage this and positioning. So hedging short-term needs for large transfers. So If we're sending back house proceeds, if you're happy with what the exchange rate is doing, then that's fine. Pull the trigger, send it home. If you've got a house settling in 6 months' time, but you like the rate now, the rate right now is pretty good, to be honest. Then you might be pay for what's called a forward contract. So you might engage a firm like OFX and say, hey, I want to lock in that price, and I'll be sending 500,000 or a million or 200,000 back in 6 months' time. There is a cost of doing so, but you are locking in the rate. Consider unhedged long-term assets within share portfolios or retirement portfolios, and that's just so you get the appreciation of the US dollar. That's a sensible approach rather than all in. Use volatility strategically, so dollar cost averaging rather than trying to time it. No one can time the market. Take those short-term wins, and also be mindful of anchoring. I know I've spoken to clients when the US dollar got down to that 59 cents mark, or the Australian dollar got down that low. So the Australian dollar is the US dollar is very strong, and they're hoping it's going to happen again. Very likely, probably won't in the next 12 months. So that's what anchoring is. Not doing anything until you see that price again. Applies to everything: property, shares, um, absolutely every different asset class you can think of. Key takeaways from today's session: equities, well, they remain resilient. They're supported by earnings at the moment. There's some sector leadership, especially within that AI tech sector, even without broad interest rate cuts over the year. Equities have still remained resilient, and that is very common. Property, bit of cooling at the moment compared to recent highs, but we're still going to see some moderate growth, and that's all you need with property. Regionals and select capital cities certainly outperforming. The Australian dollar remaining stable through 2025, but we should see some modest appreciation against the greenback into 2026 as some global policy shifts happen. If we see more rate cuts, especially in the US, then naturally that depreciates the US dollar. If we see commodities continue the theme and China keeps going and ramps up a bit, then the Australian dollar will be further supported. Interest rates, central banks near the end of the hiking cycle. Absolutely. Might not see too much more, to be honest. So gradual easing expected, but rate cuts will be measured. Diversify. Absolutely. Consider continues to deliver value across regions, sectors, and assets. We just saw that when we looked at obviously the comparison of the year to date growth of certain indexes and certain markets and certain asset classes as well within property. Remain invested and I suppose remaining disciplined when there is volatility. Remember, the price of admission when you're investing is volatility. If you're a long-term investor, it is just noise. You're not worried about it. Often we are all long-term investors when it comes to our retirement accounts. What the market is doing today isn't a representation of what it's going to be doing in the next 5, 10, 15, 25 years. It's very easy to become very emotional, especially when we're doing our own self-investing. But we've seen time and time again, even just over the last 5 years, and going back even the last 10 years, I remember Brexit as well, but remaining invested, staying disciplined. If there are some shocks in the market, it's a good time to reassess your portfolio. Is there any little rebalancing you can do? Take profits from maybe a defensive asset class and put it into growth assets because they've gotten a lot cheaper. So being mindful around that. That is all for key takeaways. We're now going to move into a bit of Q&A. So if you do have some questions, please submit them and we'll do our best to review them and dump into them. There's no such thing as a silly question. You can submit them anonymously. We don't need to just focus on what we discussed today. We can talk about super as well. And then we can jump into the, there's been an anonymous one and only one. I'm surprised. Maybe we've done our job today, Martin. One question here, and it was talking about the ASX performance. So that 3.2%. Does that exclude the dividend yields? So yes, that was only on the capital growth of that ASX 200. I think it's 3.62%. So that was only on the capital growth or capital appreciation of the ASX 200. It didn't focus on dividends. So if you were grossing up the true return of the accumulation index, then you're looking at a rate of return probably closer to about 8% if you're using a 5% dividend yield average. So that's a good example there, but that's good. Any other questions? Get them in now. We'll hang around for another couple of minutes. Really appreciate everyone hanging out for almost an hour. It's been great. Another question here. Thanks for that, Mark. That's great. Appreciate that feedback. While we wait for any more questions to jump into it, a couple of little call to actions. for you guys. We are on Facebook. We do post a lot on Facebook. I'd say LinkedIn is probably one of our main ones that we put a lot of our posts, blog posts, events out. So if you're not following or liking us at the moment, get on there, give us a follow. We post everything in there. If you're not a member of our Australian Expat Financial Forum Facebook group, jump in there. That is tracking above, I believe, 3.5, maybe even closer to 5,000 members now. We love to foster a great community there. A lot of Australians around the world asking questions and then other Australians helping them out and solving it because they've already had that question or problem and they've solved it. So jump in there. We also do some Q&A on our podcast from that as well. So if there's any, every time a question's answered and you're not getting any or much answers, we're going to answer it on the podcast. So that's a great one. Twitter. Twitter is still around, surprisingly. I feel like not too many people are on X. Maybe I'm out of touch there. And Instagram as well. That's always a good one. Another question here from Russ. Any thoughts on longer-term AUD, especially for locking in an option for an expat returning back in 2+ years? What is your views, Martin? What do you think on the Australian dollar relative to the US dollar over the next 2 years?
Yeah, I mean, I always say to my clients, it's really hard to predict currency. It's one of the most unpredictable markets you can look at because there's so much that goes into it. Typically what we see is if the RBA is going to hold their cash rate steady and we have the Fed who's likely going to start cutting rates, well, then what's going to happen is people are going to start looking for money elsewhere, which should see the US dollar decrease against the AUD. Now, what I think about 2 years ahead, I mean, it really depends on what happens. There's a lot of extra reasons why people would invest in USD and would invest outside of USD. I think it comes down to you as an individual. Our approach is always irrespective of trying to what the markets are doing from a USD, give or take, certain circumstances. But you should aim to dollar cost average, send your funds back to Australia within the next 2 years. And then you can slowly start to build your AUD so that you're not left in that 2-year mark holding on to all of this USD, praying and hoping that the USD is going to be strong against the AUD when it might not be that case. And we saw in the charts earlier today as well, it sort of moved up and down. So if you just take a standard dollar cost average strategy with the currency market, much like the share market, you can send those funds home back to AUD. But I would say that the AUD would probably strengthen at least throughout 2026, especially with the Fed starting to cut rates. If there's more geopolitical risk as well, then that'll support that too. But beyond that, I mean, no one really knows at that stage. So probably take the next year to start sending money home.
Yep, I agree with that. Structurally, the AUD should appreciate a little bit after 2026. It's a tough one because we've just got to remember whenever there's volatility within the market, whether it's the share market or geopolitical, and investors get nervous, they often flood into 3 asset classes. And the main one is the US dollar, being the major trade currency, treated as a bit of a safe haven. The other 2 is usually gold. We've seen gold hit record highs recently. There's almost gold mania, FOMO. People lining up out of Martin Place. Haven't seen that for a while. It's just a bit ridiculous, to be honest. But gold is another one, or precious metals. And then the last one is usually diversified bonds when they get a bit skittish and get nervous. So when you look at that strategy, Russ, of locking in maybe a forward contract on the AUD, I would probably question the cost of that forward contract in 2 years' time as well, because that's quite a significant time for a currency provider to hold that contract open when you probably assess the true cost of the contract relative to what the currency might be in the future, but you are committed to using that contract. That's actually a contract that you've signed and that's binding. You have to pay like insurance premiums on it, essentially to hold the contract. So based on probably a 2-year period of paying those little premiums to keep the contract there, it might not be, it might not be actually in your best interest then, based on the value that you're going to get out of that as well. Often we see forward contracts used for maybe a 3 or 4 month period. Over 12 months, that's quite a lot, but it's usually only really pulled the trigger on if that exchange rate is very favorable for committing US dollars to AUD, 62, 63 cents. Right now it's good, but I think we'll see a slow appreciation of the AUD over the 12 months. That was a good question, though. Thanks for that, Russ. Any other questions as we finish up for today? Good question here. Anonymous, sending funds back to Australia from the US. Any insights into the triple B remittance tax and beating it? Well, we've got good news for you. Martin, I'll let you handle this one.
Remittance tax, caused a huge stir, obviously, across everyone holding US and even people out in Australia or around the world receiving US assets. That essentially got brought down to a non-issue, to be honest. It obviously got introduced at a 5% rate, which was alarming, naturally. That then got revised down to 3.5% and then it got passed through at 1%. But that 1% really only applies to the money orders. So if you just use a big EFT, big bank or a financial institution and send money back to Australia, you're not going to have that remittance tax, apply to you. So, as long as you just use a financial institution, you really shouldn't have to worry about that.
Yeah, absolutely. It's a non-issue, sending money home via a currency provider online. They brought that out to just capture that cash economy, those that are sending money back home, India, Sri Lanka, even Mexico, just because a lot of that money wasn't being taxed at all. Started off very severe, 5%, but now it's dropped down. But for all we know and all we've seen, and this has been verified by OFX and their compliance team, doesn't impact those online transfers at all. So it's good, really good news. That's great. Any other last minute questions as we wind out for today at 10 a.m., 11 a.m. New South Wales time? Might leave it there. Well, thank you everyone for joining us on today's webinar. The recording will be made available very shortly. Slides will go out. If you do have any queries or questions or want anything else answered or want to set up a consult just to assess your own situation, feel free to jump on our website, atlaswealth.com, submit an online inquiry, and it will come down to the professional that you require. In the meantime, Martin, thanks for joining me on today's webinar, and thank you everyone for joining us for an hour.
Thanks, guys. Appreciate it. Cheers, James.
Thanks, mate.